Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast.
Hey there, welcome to episode 56 of the Financial Purpose Podcast. And sorry, I'm getting a weird notification here. Okay, done. This episode I want to talk about because this, I choose the podcast episodes usually because it's something that somebody recently it came up in a client meeting or in a conversation with somebody at a networking event or, a friend or something like that. So usually it's somebody asks this question, hey, that's a really good question. Let me talk about it. And sorry, this thing's like going nuts on my wrist. I might throw it. Okay. Anyway, it's not important. I promise. If it were, I would just stop and answer the call, but I don't need to answer that. So anyway, this one in particular is around investment minimums. And this is a question I get asked all the time, especially when I'm being interviewed by a prospective client and we're talking about all the different things that I do and the way that I approach wealth management and how I look at financial planning, the investment strategy that I employ, all of that stuff. And they go, great. What are your fees? Of course. What's your investment minimums? How much do I have to have? Because I've talked to an advisor before and they won't talk to me if I don't have $1 million or pick your number. They're kind of all over the place. Where this one came up is I have a client and they have a child who just recently graduated college. And the question was, hey, son, whose name shall be withheld to protect the innocent, just graduated. He's got a little bit of money saved up and he wanted to talk to you about what to do with it, maybe get your help investing it and, kind of just get started planning and all the good stuff young. He really has a good head on his shoulders, wants to do it the right way, wants to get started. And he wants to know how much money he needs to have before you'll talk to him. And I was just like, dude, I've known this kid for, 10, 12 years. Have him call me. Let's talk about it. Also, yesterday I was at lunch with a client and we were talking about his investment strategy, and he asked a couple of questions about some of the recent changes that and adjustments that I've been making to the investment portfolio and what I was seeing with the economy and the markets and real estate and all of this. And our server overheard the conversation, and as we were walking out the door, he stopped me and said, hey, I've been investing for a couple of years and, I'm trying to get one of my coworkers to start because, he's in his late 20s and you really got to get started. And so I overheard you talking about this, tell me about what you do and how it works. And so we just gently, just having a little conversation, not a big deal, exchanged information, all that fun stuff. And then he said, oh, by the way, how much do you have to work with you? Because I know, sometimes, until you have enough money, you won't talk to us. And I'm like, okay. So clearly what's happened is my industry, the financial services industry, the investment industry, whatever we want to call it, for years, we've set this precedent where we only want to work with affluent, high net worth individuals. And we all want, to do that. And the reason why simply is because if somebody has more money to invest, under most traditional compensation models, the advisor gets to earn more money when more money is invested in the markets. And a lot of times that comes in the way of commissions. Now, that started to kind of unwind a little bit into the mid-90s to early 2000s when we went from commission and trade fees into managed accounts, and then from managed accounts into assets under management as a compensation model. And so now everybody's used to the word assets under management, or AUM, you might see. And some advisors will say, I won't talk to you until you have $1 million. Some will say, I won't talk to you till you have 500,000. Some will say, I only work with high net worth families with $3.5 million to invest or above. Some are even higher than that, right? Some hedge funds, if you're not walking in with 100 million, you're not in. And so investment minimums are an old way for advisors to filter out prospective clients. And basically what they're able to do is they can set their minimum. It's basically like you're walking in, you've got a dollar amount on your forehead, and the advisor wants to make sure that you're going to be worth their time. Advisory firms and advisors can set these minimums. It's a way for them to target growth of assets, and that leads to a growth of revenue per client. And in fact, advisors I always hear this. I'll have fellow advisors at conferences or in networking meetings, or even some of the advisors I know from before I was an advisor, they were just friends of mine. They might, occasionally we would talk, hey, what's your AUM up to? How much are you managing now? And basically, it's almost like it's a measuring contest is what I call it, and I call it a very specific measuring contest. Use your imagination. Now, from a business management perspective, as a business owner who works with business owners, tracking and managing KPIs and knowing what your revenues are and targeting, specific price points, that all makes sense. Now, I have a minimum, but it's not an investment minimum. I have a minimum target for the average fee per client. That's good business, but that average fee per client is negotiable based on what's going on, and it often has nothing to do with how much money somebody's walking in with. So part of the other problem with using an asset under management is that it creates a barrier to access, and investment minimums lock a lot of really good people out of receiving quality financial advice for far too long in their adult life. Because if you think about how long it takes, unless you're, an inheritor or you develop some sort of technology that gets bought by somebody else, and then you go from having no money to being a multi-millionaire or billionaire based on something that you created or an idea that you had. Well, those are sudden money events. Outside of that, it's very difficult to start when you're 22 and save up to $1 million without some big event happening, or without you going into an incredibly high-paying job where you're able to just sock away a lot of money. For most people, it takes a long time to get enough money to think that you don't have enough to work with a financial advisor. And so you don't get the quality advice. Now, on the flip side, high net worth individuals have been trained to see investment minimums as an indicator of the advisor's experience. I actually was working with a prospective client one time, and we were talking with the couple and one of the parents, and the parent said, hey, how much do you have under management? And I told them where I was at the time, and the feedback came back to me that the parent thought that because I wasn't managing as much money as they expected, I probably don't know what I'm doing, or I haven't been in the business too long, or I just don't have enough experience. And the truth is, that's actually not true because of the way that I've built my practice. My goal is not to collect a big amount of money because that's not my metric. Now, of course, I manage investments, and of course, I would rather have clients centralize their investment decisions and activities and allow me to help them manage that. But it's not a barrier of success, and it's certainly not a barrier of how much the advisor knows or how well they're doing. Quite frankly, I think that sometimes some people look at it and they go, oh, that guy must not know how to sell. And that's exactly the point. I do not want to sell, which is why I'm a fee-only advisor, and I don't do commissions. So anyway, clients who can meet those higher minimums, they're led to believe that they'll be served at a higher level. They'll have an access to a wider range of wealth strategies because they have more money. So they're above average. They're above the fold. They don't have to go to one of these smaller, brokers, or one of these smaller little advisory shops, or, the neighborhood financial advisor with the, certain two named firm with the little green signs. some investors look at that and even look at firms like mine and just go, well, I'm above that. So that's what those asset minimums typically do. And so I want to talk just a little bit about why I've chosen to not do an asset under management as the barrier to entry. And I want to talk a little bit about how the fees work and disrupting that old model. And I think this is helpful. I hope that it's helpful because if you're listening to this and you've never sat down with a financial advisor because you think either you don't have enough money to qualify or you can't afford it, I would challenge you to challenge what you think about that, because you most likely have things going on. You're a busy individual. You might own a business. You probably own a business if you're listening to this podcast, or you work for somebody who owns a business and you're somehow involved in driving the operations or the sales of that business. And so you're a professional. You probably have a home and a car and kids and a family, and you're concerned about college and you're concerned about your retirement, whatever that looks like, because we've got to do some work to define that. You're probably worried about managing higher interest rates and how you're going to pay off some debts, and you're worried about making sure that your 401k doesn't get walloped if the stock market goes sideways. And you're probably concerned about the stock market going sideways because you're on social media and you've heard a bunch of people tell you that your 401k is dumb and you need to buy a index universal life insurance policy. And so now you're worried about life insurance and if you have enough. And there's a lot to think about. And having quality, professional, good, solid financial advice is helpful to you. What's not helpful to you is a financial advisor who only wants all of your investment accounts and only wants to talk to you about the investments that they think are sexy and only wants to talk to you about what's happening in the stock market. Those things are important. Investments are very important. They're one of the 7 key areas of financial planning. They touch all the other 6 areas, and all the other 6 areas touch all the other 6 areas, right? So it's all, you've heard me say this before if you've listened to the podcast for a while, and if you haven't, here's the new term. It's all financial spaghetti. It all touches. Everything touches everything. And so you're going to want to get good investment advice. And again, I would challenge you to talk to a financial advisor, get some information on what's helpful to you, and you're going to very quickly know if that person is a real financial advisor or if they're somebody who just does investments. And there's a huge difference. So I want to talk about where people are getting advice in the absence of getting good advice. And a lot of it is they're really just trying to get what they can find. So they're ordering books, they're reading books, they're getting social media financial experts who, as I said earlier, are usually trying to sell you life insurance policies. They might be trying to sell you into mutual funds. They might be trying to sell you annuities. A lot of times you're going to have blog sites. They're going to talk about index funds or, what stocks are hot or the top 5, picks from, I'm not going to name them I don't want anybody getting mad at me, but, that there are certain blog posts out there and there's a couple that are really very famous and they're going to tell you about what's up, what's down, what are we expecting? Here's the top 5 picks you must have in your portfolio if this happens or if that happens, or right now at the start of the year, or here's the best AI, top 3 AI picks, or they're going to do all those things. You're also going to have some of those blogs and a lot of people on Twitter especially, who are day traders. And so they're going to be talking about, their puts and calls and the various things that they're doing. You're going to have people who tell you that gold is the way to go. My father recently asked me if he should cash out his 401k and buy gold because he heard that it was the best investment because, the world's going crazy. And I was like, what? Who are you listening? Stop listening to that person, right? But your neighbors and your friends and your family and radio show hosts and podcast, there's so much information out there. And the challenge with all of that is that they offer quote unquote advice. Often, if it's a person, it's always going to lead to a sale that gets them some sort of compensation or commission. It's going to be a stock tip that you don't know what to do with. Maybe you buy it, maybe you don't. I heard somebody, again, camping recently, somebody was like, oh, yeah, my buddy told me to buy this, and as soon as I bought it, it went down. And then I'm stuck with it. And so that happens sometimes, but usually those like, hey, I got the one that's going to work for you. Hey, you should get in this because it's going crazy, right? Like that. Anytime somebody shoulds on you with those kinds of stock picks or investment strategies or whatever, it's usually a good little red flag. But it's often not only is it maybe the bad direction, it's often completely disconnected and not even relevant to where you are in your financial life and what you have going on and what you're going to need for yourself. So the real financial advice is not in any of those places. And in my opinion, like I said earlier, the industry's created a big gap in this because everybody's sticking to the AUM and the commission model. And so that just kind of keeps some people out. And so the real good financial advice, it's got to be done in the context of, if you make this investment, it will impact your taxes. And if it impacts your taxes, we need to look at your cash flow. And if we're looking at your cash flow, we've got to consider what risk financially you're exposed to so it doesn't ruin your net worth. And if we're thinking about your net worth, we've got to tie that to whatever's happening in your estate plan, right? So you see how this all gets kind of mixed up, and it's all, again, that's spaghetti. So the advice gap that we have because of the asset minimum and the AUM model and the commission sales thing, it's one of the biggest reasons that I launched Life Moves Wealth a couple of years ago. Financial literacy is not widely taught. I spent 5 years prior to the pandemic, and even I literally was in a high school 2 weeks before it got shut down for the pandemic. Those 5 years, I went once, sometimes twice a year, and I taught financial literacy. I took over the econ class for the day, taught the kids about how basic money works, how basic payroll taxes work, and what they need to expect when they're getting ready to go to college. And I made it fun and interesting, and I threw candy and, all this stuff. Because we don't do that, right? We don't teach people fundamental, mass applicable financial information, right? I know we don't necessarily need to teach people how to write checks anymore and address envelopes because nobody does those things really. But it's important to understand the basics of when you swipe a credit card, it's not magic money, right? There is an impact. When you go to work, you say you earn $20 an hour to flip your hamburger or whatever you're doing these days for $20 an hour, which seems a little crazy. But anyway, you don't get the full amount of that $20 an hour because you're going to have to pay taxes. And, oh, why do you pay taxes? And oh, you want free healthcare and you want free education and you want free whatever. Okay, well, guess what? You're going to have to pay taxes for that. So there's no such thing as free anything. And there's also no such thing. This is my soapbox that I just climbed on. Sorry. There's also no such thing as government funding, right? Because the government has no money until we give them, until they take money from us, then they have no money, right? So none of that stuff's free, and we need to start teaching kids that stuff. And it's funny, I had a teacher once tell me that I walked into class and he had a whole bunch of socialists, and by the time I left, they had all become capitalists. And I thought that was one of the best compliments I had ever received, because that's exactly the goal. Like, you have to understand how basic economics work to be able to go out into the real world and know what you're doing and make good choices with your money and keep yourself from getting completely sideways with bad decisions and taking bad investment advice and over leveraging yourself and voting because you don't understand money and taxes and things like that. So limiting access to that kind of advice is part of the problem. So many of the clients at Life Moves Wealth, they receive actually most of them now receive ongoing financial planning and investment advice. It's on a flat fee basis, and it's a fee only thing. So I'm working the assets under management model out of my process as much as possible, as fast as possible, and have been over the past 2 years. And the great thing about it is that it makes me completely agnostic to where wealth is being built, as long as we're building wealth, because what matters is the financial advice, not the percentage of the money that I get to keep and manage, so that way I can make sure I still have a paycheck. It's just fundamentally changes the conversations. It gives us a better approach when we're talking about different decisions that we need to make. A lot of the people I work with, especially younger professionals, they're pushing most of their money to a company-sponsored plan. If I didn't have the model that I have, they would have no access to or limited access to financial advice, because there aren't a whole lot of people like me who will say, no, you can pay me X number of dollars per month. By the way, you can see the fee structure right on lifemoveswealth.com/advisory fees. It's right there. You can see where it starts, how it goes. But they benefit from having the ability to pay a monthly fee, or an annual fee that they pay monthly is actually the way it works. And they can have direct access to financial advice any time that they need it, regardless of the fact that I don't manage any money for them. Now, I have some clients who I manage all of their money, and we're still on the flat fee basis. And I manage a lot of their money, and we're still doing financial advice. And certainly for business owners, oftentimes they don't have a whole lot of savings. Some of them do, but a lot of small business owners, they save very little because most of their net worth and their cash flow is tied up in their business asset and then their personal real estate. And they often have not very large investment accounts. And so a lot of financial advisors won't talk to them until they sell the business and have the money to manage. And so it just makes sense to have a fee model that's not, again, based on how much money you have. So, sorry, I'm looking at my notes here. I'm going to skip over. Yeah, I'm going to skip over that. So, because I'm like totally lost on my notes here. I'm so sorry. This is how you know it's live, and this is how you know I'm a real person, and this is how you know AI didn't write it. So, la ti freaking da. All right, so why fee-only investment advisors have an advantage. How's that for a transition? So, all right, fee-only independent financial advisors have a large advantage over the big firms because the motivations for how clients are served vastly different. Independent advisors like myself have a lot more flexibility in how clients are served, how clients are billed for the services, what amounts, what technology, and what tools that we will use to best deliver the client advisory experience, even what investments we select. And that's a dirty little secret in this industry, because there are some investment advisory firms and some financial planning firms who only have certain investments on the platform because the investment management company won't pay a high enough fee to have more of their ETFs and mutual funds on the platform. Did you know that? It's a dirty secret. So you want to be able to find somebody who is independent, because they basically have the ability to go get anything that we need to have in the investment portfolio without having to worry about, oh, my firm doesn't have that specific ETF, or they won't let me offer that specific investment, or I can't buy that stock at your direction because my firm says it's a sell-rated stock and they don't allow it in any investment portfolio, period. Or my firm doesn't have the lower cost mutual fund shares because the mutual fund company won't pay enough to offer that one, so we just have the higher cost ones, and that's all that we have available, right? So those little games get played. Being independent allows me to go get whatever we need and not have to worry about what my big firm says I can and can't put in the investment account, or what my big firm will or won't allow in because of how much they're being paid. It's absolutely ridiculous. But it also removes certain conflicts of interest related to compensation. Great example is a couple years ago, I had a client who needed to buy a house. It was a situation that they were between homes. They needed to make a quick move. And we had to take money out of an investment portfolio, buy the house in cash, And then they went a couple months later and did what's called a delayed purchase mortgage to put the money back into the investment portfolio. And that kind of conversation under any other model, especially under an assets under management model, that advisor is probably going to be thinking of a different way that they can get access to money. Like, oh, no, let's just leverage the account. Let's do a margin loan. And we can take that loan and you can buy the house and then you can pay the loan back over time, or worst case scenario, we can sell stock and pay the loan back. Now, the trick with that, for that large of an investment or that large of a withdrawal, is that if the market goes sideways or goes down. Now, this situation happened at the very beginning of 2022, and the summer of 2022 was absolute hell in the markets. And so in that case, that client would have been called on their margin loan, and they would have had no great ability to meet that margin call without selling stock. And then selling stock means that they're losing value in their investments involuntarily. And so you're going to do that anyway with the stock market, but margin loan is there's interest attached to that and whatever. So by having the model that I have, which is, again, fee only, it's a flat fee, not worried about AUM, in that situation, we're able to do what's right for the client, analyze all of the options, and just say, okay, in this case, the best option is to take the money from the investment account, buy the house, set up the delayed purchase. I'm going to have you work with this particular mortgage advisor who knows how to do this thing. We're going to make sure that the timing is right, and we'll get the other property sold. We'll move the money, and we'll get it back into the investment account, right? So we can actually do a strategy that has absolutely nothing to do with, oh, and by the way, because of the amount of money that you're taking out to buy a property, and you can think about the number of hundreds of thousands of dollars that might have been. Oh, by the way, that's going to be like a pretty big pay cut for me. And so I need to think about that. Well, that's a conflict of interest. And as a fiduciary and as a certified financial planner, I have to put you first. And so that conflict of interest has to be removed. And the conversation of, oh, if I do this, then I'm going to lose money as the advisor, or, oh, if I do this, then I'm going to gain more money as the advisor. If I sell this to them, then I'm going to get more commission. That's a conflict of interest. And so those have to be disclosed, number one. And they really should be avoided by the advisor. And that all comes back to how that advisor is compensated. So I did a podcast on how to choose the right advisor for you. That's episode 29. You can go back and listen to that. In addition to that, I mean, basically, the best thing that you can do when you're looking at a financial advisor is look for somebody who is fee only. Look for somebody who's a CFP. And I'm not trying to say that anybody who's not those things is not a quality financial advisor. They very well may be. There's some really good people out there who don't have the three letters and don't have the ability to be fee only because they work for a different firm, or that firm doesn't allow that kind of structure or whatever. And they're good people. But I would tell you, if you have the options, you're probably going to get a little bit more transparency and better advice. And I'm biased, and somebody's going to hear this and maybe get upset, and I don't care. I'm biased. I can say it. My show, right? Go get a fee-only advisor. Go talk to somebody who's not going to wallop you with commissions and immediately start selling, from the first 25 minutes of the meeting. Find somebody who can do that, is a CFP, does investing through the lens of financial planning, and is very straightforward with whatever their fees are. I recently met a business owner at an event. During the conversation, he mentioned that he talked to other advisors in the past, but none of them can help because all of his money was tied up in the business. And so, again, the direct quote it was, and I wrote this down, one advisor tried to sell me insurance on my employees, but it wasn't right for me. And if only there was an advisor who could help me with financial planning and business exit planning without requiring that investment minimum or requiring me to buy something, like insurance product or whatever. And that's the old ways that that people call wealth management, air quote, wealth management. And I just think that's rapidly going out of style. The capital markets, the economy, the stock markets, it all moves too fast now, even faster than they did 10 years ago. And advisors who only know how to offer investment advice and sell insurance products, they know nothing of their clients, cash flow, tax concerns, estate planning, risk exposure, business valuation drivers, how they price their product in their business, how well their management team is prepared for an exit, how dependent that owner is or isn't on the business and vice versa. Is the owner completely living out of the business, right? If your advisor doesn't know those things because they don't have the information and they don't go that deep and they don't want to mess with anything about the investments, you're just simply not getting real and complete advice. So, you can invest yourself. You can go on Robinhood. You can go on any number of these platforms, E-Trade, whatever it is. You can do this on your own. Fidelity, Vanguard. It's just too commoditized now. It's not even really that much of an edge. Investing is not an edge. Sometimes manager selection gives you a little bit of what we call alpha or outperformance because maybe they were quicker or earlier into a certain investment that now is in favor, and so you're able to. Yes, sometimes that happens, but anybody can do that, right? If you know how to read the markets, if you know how to read the economy, and if you don't, you probably ought to get somebody who does and can tie that into what's happening with your financial plan. So if finding the right financial advisor for you has been a challenge, or if you have hesitated from talking to a financial advisor because you don't want to be sold something and you don't think you have enough money and you don't think you can afford it, actually might be a good fit for you. And Life Moves Wealth might be a good fit for you. So if you go to lifemoveswealth.com, you can get your financial scorecard. You can schedule time for a free investment portfolio checkup. You can see our fees. You can even see our monthly advice calendar. If you're a business owner, there's specific resources for you over there. You can download. There's a couple of great worksheets that you can download, checklists, things that you can work through based on what's happening in your financial life. There are multiple financial calculators that do different things based on what you want to calculate. There's a lot of really good information there. And by all means, learn more about the process, read some of the blog posts, listen to this episode and some of the other ones, like, subscribe, share, all of that fun stuff. The big idea here is that we have a process that our clients love and they tell other people about. Life Moves Wealth does almost no marketing. We do a lot of content creation. We post a lot on social media. We sponsor some charitable things here locally, but we really don't advertise very much because our clients refer to us. They send people that they know because our clients trust us, and they trust us enough to say, I trust this person. I'm going to refer somebody that I care about to this person that I trust because I know that they're going to take good care of them. And that's a blessing. It's also a testament to the fact that our process works, and it works well for people, not just because they, get good investment returns. We get good investment returns, but they get excellent financial advice along the way, and that's incredibly important. So, again, go to lifemoveswealth.com, check it out, go through the website, read the pages, follow the advice. Like I said, get your scorecard, get your investment checkup, all that fun stuff. Find out why our clients really love our no BS approach. And a lot of what I talked about in the industry is total BS. I'm on a mission to change it, and there are many advisors like me who are as well. Often we're gonna probably tote around, if you can see it on the, I don't know if I have this lined up correctly on the camera, but you can see this little sticker, this little dragon. If you walk into somebody's office and you see one of these dragons, or you see a Sharpie sketch on the wall, and it says behavior gap underneath it, you're going to know that you're working with somebody who's on a mission to change the industry and give good quality financial advice and do it the right way for the right people. So if you're that person and you've been challenged by that, like I said, head over to lifemoveswealth.com, send an email to info@lifemoveswealth.com, leave a comment, and happy to talk to you, happy to do all of that stuff. And by the way, there's no charge. If you just want somebody to look at what you have or what you don't have or what you think you have, if you're looking for some direction, if you have a question about something that's happening in your life and you're concerned about the financial impact or the tax impact or the estate planning question or any of that stuff, ask the questions, get the answers that you need. If it makes sense to enter into an advisory agreement, we'll do that. If it makes sense to get you pointed in the right direction, we'll do that too. So anyway, that's it. I hope that this has been just kind of a mental reset into what the advice industry is all about, how the fees work, why there's a lot of complications and a lot of just like really, I've said it so many times, there's so many bad conflicts of interest. And so if we can get those removed and you can get good quality advice, then the world just tends to turn better. So that's it. Drop a comment, like, subscribe, share. I hope this has been helpful. And until the next episode, go be financially awesome. Take care of yourself. See ya.
Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.